Is your debt on fire? We're here to extinguish it. This is the IssuesWatch podcast. Hello and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an assurance principal at Clifton Larson Allen. And back with me today is Matt Charney, an audit director at CLA, and Marissa Flood, an assurance senior at CLA. Welcome back.
Thanks, Brad.
Thank
Good to
you.
be back.
Yeah, I don't know if we should be saying welcome back because you guys are going to be running this thing. So, you guys are just going to be regular. I think you should be saying that you're regulars now.
Squatters' rights, really.
Okay, all right.
Yeah, those come into play now.
Okay. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. Quick disclaimer, the views and statements expressed herein are our own and not necessarily those of NJCPA or CLA. Okay, well, it's still been a light year, although you've seen, I actually sent you a couple emails recently of some stuff that's come out on, on software was one.
That's a good one, yeah.
Yeah, we should probably cover that one time, but that's going to be really deep. Do you deal with software at all, really?
Not really.
Okay, yeah, he's got to love it. Him and
He loves
Spinetta love it.
software.
Oh, yeah.
No, this is a
That-
good one.
that's a
I
Matt
think
topic.
that'll be a good episode.
Okay. And another one that's just came out where they talked about business combinations.
Mm-hmm.
The FASB gave some clarification on business combination, defining I think something like the company or something that's being acquired. So some interesting stuff came out, and then they have this one that it's an exposure draft that's out. Now you sit there saying, should we really be focused on exposure drafts? We don't bring up all the exposure drafts all the time. We try and bring up stuff that help that have connection to what you're also doing now. So this one's interesting because this is debt modification and extinguishment. So I'll avoid the ASC references. Extinguishment of liabilities. Now, let's not go into the area of if you're just going to take a liability off your book. Derecognition. Just derecognizing, and I know we hate that derecognition for the SCADA beats. Just derecognizing a liability, because you cannot just take a liability off your books. You can only take a liability, well, if you pay it, okay, or if it's exchanged.
I was going to say.
Okay.
There is one way.
But you can't just say, oh, we haven't paid it in a while, they haven't asked for it in a while, we're going to just take it off the books. There's only two ways you can take a liability off the books, is if the creditor agrees to it. Well, you're not going to call the creditor and say to him, hey, I owe you the money. Do you want it?
Yeah, does that happen often?
No. I recommend it to my clients all the time. I don't know why they won't do it, though.
Yeah. I used to have a client that had a don't ask, don't tell policy.
Okay.
So they would have a liability on the books. Doesn't matter how old it was. The vendor didn't ask. They weren't getting paid.
Okay.
And when time came to take it off the books, like you said, we had to get in a bit of a discussion with them and said, well, were you legally released from this or not? And if the answer was no, there it sits.
So the SEC had told us one time that it's either if the creditor agrees to it, which you're not going to do, or it's adjudicated. So you're not going to go to court to try and get this off because, by the way, then you're going to be telling the creditor about this.
Right.
I'm going to have a few more liabilities after
Right.
that, too. So.
Yes. And we did have, in one instance, where an attorney gave us a whole opinion on the statute of limitations of the vendors being able to come back, and we just sat there and said, "You're looking to write off $40,000, and you're writing an opinion for $40,000 when you have $5 million of liabilities." Yeah, but the other one is when you have that on the books and it's being extinguished, either it's being exchanged or there's modifications.
Right.
Now, the current gap was unclear as to when you should be taking either of the approaches. The two approaches are if there's a modification and the issuance of new debt and an extinguishment of an existing debt obligation. Okay, it was pretty unclear as to which way you should be going and how it's looked at. Now, so I went through this whole thing. I read it, and I read the article about it. I read the draft that's out. And I said, oh, good, it's going to be nice and clear. And I went through it, and I said, they're pretty much recommending the same thing. Now, I'm going to read to you what it says, because they're trying to reduce diversity in practice. So here, the exchange of a debt instrument would be accounted for as issuance of new debt obligation. Okay, so we're clear on that. And an extinguishment of existing debt obligation. Okay, if one, the existing debt obligation has been repaid in accordance with the contractual terms. Okay, that sounds right. Or repurchase at market terms.
Okay.
Okay. And the new debt obligation has been issued at market terms following the issuer's customary marketing practice.
So it sounds like if you can take the debt off the books if you pay it,
Okay.
same as before.
Right.
If you refinance it, which I think same as before, or if you are legally released from it.
So
It's treated as a
Same
new
as
debt
before.
obligation.
Yes.
So underscore that because the other one's going to be just a little different. It's treated as a new debt obligation if, to your comment, you pay it, or if it's refinanced at market rates.
Okay.
Okay, and now that's where the tricky thing that comes up, and that's why I wanted to bring this up. One of the things that I found that snuck out, somebody like Jim Steiner, who's one of the smartest people in our second review pool, hit on us one time. Somebody did a refinancing, and it wasn't. You could tell it wasn't at market rates, and it just wreaked havoc on something.
He picked up on that. Huh?
He picked up on what Steiner. You could pick, you walk over
That's
here in New
impressive.
Jersey, and he's in Minnesota. He picks up on something you did wrong. Okay, he's really, but the nicest guy ever. I called him on a question yesterday relating to interest rate cap on swap, and he sent me something at 6:00 this morning. Yeah. So the second one now, ready? If the new debt obligation has a single creditor or the transaction do meet the conditions of meet those conditions, an entity could evaluate whether the instrument has substantively different items under section 470 to determine whether transactions should be accounted for as as one, a modification of the existing debt obligation, or two, the existence of new debt obligation.
That's a mouthful.
That's
Let me.
a lot to take. They said this was clear. This is giving clarity.
Yes. Right. Let me go back to those first two bullets.
It lacked clarity, and now we have clarity. Oh, perfect. I'm not clarified.
You're not clarified. No, I think I've had more milk that's better clarified than this. All right, so that's out there, and I just wanted to bring it up to show you some of the weird stuff they're working on, but they are trying to focus on, okay, if you do extinguish debt, either by payment or modification, how should it be treated? And based on the way it's out, I don't think it's going to be very clear right now.
Yeah, the only silver lining I can think of is because it's an exposure draft, they usually collect comments, right?
Right.
So if you're hearing all this and you're as confused as we are, leave a comment for them. And
That-
maybe they'll fix it.
That's a great point.
Yeah.
That's a
Yeah,
really
that's
great
a
point.
good point.
Yeah. The other thing is what I wanted to bring it up for is statement of cash flows. So one of the things that's popped up a lot we've seen in our office is that the reporting of a statement of the line of credit on the statement of cash flows. Now, we've always reported my career, not CLA, in my career, and I'm talking from when I started my career in the second year of my career in 1989, a manager told me the line of credit is shown net. It's silly to gross it up. Well, there's a charge right now because the price PwC guidance came out. You know, it's not authoritative, but it's their guidance, and a lot of people rely on the Big Four guidance that says the line of credit activity should be shown gross on the statement of cash flows. I don't know if you've gotten any comments on second review but
I always tell my staff to show all of the debt activity gross.
Gross.
Because I thought it was required.
so
So I guess I'm just ahead of the curve.
you're ahead of the game. So, and I've seen in the guidance, the actual guidance, where it doesn't say line of credit, it references line of credit, but it doesn't. It says it has to have certain characteristics. I just don't think it's interesting enough, or it helps the reader seeing $50 million of borrowings and $50 million of payments. It just skews it, but that's what they're doing now. And just look at that and watch that and think about it because you may have it in your financials. The last thing we'll mention real quick, ARSC, the Pirates, Accounting Review Standards Committee put out a new SARS number 27. It's applicable to ARC 70 financial statements prepared as part of a consulting engagement. So what happened is if we can prepare financial statements. And then there's a compilation, which is just a report. And then there's a review, which is a report, but we do attestation services, and there's an audit, and there's greater attestation services. But preparing financial statements is a non-attest service that we can provide. And it falls under SSARS 20, I believe it was, where they said you can prepare financial statements. Well, they said, how about during consulting service if we're doing financial statements? We go out and we're helping them with their operations. As part, we have a financial statement we want to give to them. What happens then? And ARSC has determined if you're doing consulting services and part of the result, a byproduct, is that you're handing over a financial, it's okay. It falls under the consulting services and it doesn't fall into peer review then. Now, if you're hired and the large part of you being hired is to produce financial statements,
Yeah, because then people will obviously gravitate towards that because, they're not getting peer reviewed.
Exactly. So if you're hired with the intent that financial statement is the main deliverable, it goes back under the SSARS and goes under peer review.
Okay, so I imagine that will capture 90% of what's out there.
Exactly.
Right.
Exactly. So you really need to have your engagement letter defining what your services are.
That was my next question.
That's really what it's pushing towards.
Yep.
Make sure you have an engagement letter. Make sure your engagement letter defines these are the consulting services we're providing, and as part, we will review financial statement. If you say these are the consulting services to do financials, no good.
Right.
Okay. So, in closing, here's some upcoming accounting and auditing events. It's not too late to register for the NJCPA Convention and Expo taking place June 3rd to the 6th in Atlantic City. There are single-day and multi-day registration options. And learn how to avoid deficiencies in your peer review in a webinar on June 16th. And the annual Governmental Accounting and Auditing Conference is on July 22nd. Get information on these events and more at njcpa.org/events. And of course, be sure to join the Society's Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening, and we hope to see you at the convention, and you'll see these are